Welcome to TalkTickers. We cut through the earnings call noise to give you, well, what really matters for your investment thinking.
Exactly. And today we're diving into the latest earnings call from a major player. Let's unpack it.
Right. So the headline seems to be a slow start to the financial year. Was that expected?
Yes, largely anticipated. We saw an adjusted EBDA, that's earnings before depreciation and amortization, landing at negative 139 million for the quarter.
Okay.
And adjusted net income also in the negative at 143 million.
Oof. Okay, let's unpack that dip. What's really driving those negative numbers?
Well, it's mostly about normalization. You have to remember the previous year was exceptionally strong, particularly with hedging margins and their trading. Those are coming back down to earth now.
Right, so less of those trading gains.
Yeah.
Anything else?
Yeah, the gas curtailment gains they booked last year, those didn't repeat. And then there were some pressures in the gas midstream business. Think past optimization moves and pulling out higher priced gas from inventory that hurt margins.
So a bit of a come down from unusual highs. But what about looking forward the rest of the year?
Despite this, weak first quarter, they've actually confirmed their full year outlook for 2025.
Oh, interesting. So they expect things to turn around.
Definitely. They're projecting adjusted EBDA between 900 million and 1.3 billion for the full year.
That's a huge swing from Q1.
It is. And adjusted net income is expected somewhere between 250 million and 550 million. So yeah, they're banking on a significant recovery through the rest of the year.
Do they have the financial footing for that kind of turnaround?
It looks pretty solid, actually. Their economic net cash position was 2.6 billion at the end of March.
Okay.
And they've also made progress paying back the German government from that 2022 stabilization package. Another chunk repaid, bringing the total to 3.1 billion now.
Right, chipping away at that. Okay, let's get into the strategy stuff. I saw they made a decision on new long-term LNG contracts. That feels significant.
It absolutely is. Making a financial investment decision there signals a clear strategic direction. It's a bet that LNG will remain, crucial for Europe for quite some time, even with the green transition, provides a hedge.
And what about their power plants?
Yeah.
The flexible generation side?
Some good news there, particularly in Sweden and the UK this first quarter.
Oh yeah, what happened?
Well, in Sweden, they actually reactivated a 448 megawatt gas plant, the FAT plant, for security reserves. Shows you still need that dispatchable power.
Mm-hmm.
And in the UK, they did really well in the T4 capacity auction. Secured contracts for 4.4 gigawatts of spare capacity.
4.4 gigawatts, that's substantial.
It is. And the price was good too, 60 pounds per kilowatt. That alone is expected to bring in around 300 million in future earnings.
Wow. So that UK win, what does it tell us more broadly about how the European electricity market is evolving?
Yeah, it really underscores how important these capacity market mechanisms are becoming. Governments want to ensure the lights stay on as more renewables come online. So these auctions pay generators to have capacity ready.
Right, paying for availability, not just energy seduced.
Exactly. And their success shows they're positioned well to benefit from these market designs.
And speaking of government influence, Germany's got big plans too, right? Building new gas plants.
Yes, huge plans, up to 20 gigawatts of new gas-fired power by 2030. And crucially, this is linked to setting up a new capacity market there as well.
Seems almost tailor-made for a company with their kind of experience.
It certainly plays to their strengths in conventional power. They also sounded positive about Germany's plans for what they called a legit list package for carbon capture on gas and biopower plants.
Legit list package? What's that?
Basically streamlining the approval process for CCS, making it easier to get those projects off the ground, which they see as, important for the long haul.
Got it. And they expect the tendering for these new German plants to start soon.
They're hoping for early 2026, and they're really emphasizing their century of experience, their existing sites, especially in Southwest Germany, saying they're ready to go.
Makes sense. They mentioned maintaining their market share too, around 10%.
Yeah, they currently have about 10% of Germany's conventional capacity, and their ambition is to hold on to that share even as the system transforms. So they plan to be a big part of building these new plants.
Okay, let's shift over to the gas market itself. Sounds like still pretty choppy waters there.
That's definitely the read. The European gas market is still facing, Geopolitical uncertainty, questions about future supply. It's complex.
And market signals aren't great either.
Right now, the summer-winter spreads, the price difference aren't very attractive for putting gas into storage. Plus, the overall economic weakness is keeping a lid on gas demand outlook. And you still got high withdrawals from storage happening and this sort of regulatory uncertainty hanging over things.
But they did welcome one government move, didn't they? Lowering storage targets.
Yes, the German government decided to lower the minimum gas filling level requirements. That gives them more flexibility, which they appreciated. And they hope the EU might follow suit.
Okay. And the gas midstream business specifically, you mentioned it dragged down Q1 results. Why was that performance anticipated?
It goes back to the crisis years. They had to fill storage with very expensive gas back then. Now they're withdrawing that high-priced gas, which hurts margins.
Right, the hangover from the crisis.
Exactly. And there are also some B2B forward contracts from that period that are still impacting results.
But is there light at the end of the tunnel for that segment?
Yes, they do expect improvement. Their LNG-related forward contracts, especially the newer ones, are expected to contribute positively, quite significantly, actually, for the rest of 2025.
So the LNG deals help offset the other issues.
That's the plan. Offsetting losses elsewhere. And looking further ahead, they project 2026 will be the first year without these negative hangover effects from the crisis in the gas midstream business.
A clean slate in 2026, potentially.
Yeah.
And they're doubling down on LNG with those new deals. Woodside.
Absolutely. 2 new contracts with Woodside, 14 terawatt hours per year each, running until 2039, plus other pipeline deals. It's all about building a strong, diversified international LNG portfolio.
Diversification and scale.
And strengthening their sales arm, too, aiming for up to 200 terawatt hours a year in B2D sales focused on Germany.
Okay, let's dive deeper into the quarterly numbers. You said adjusted EBDA declined year on year across all segments. Can we break that down?
Sure. The greener commodity segment had an operating loss of $492 million. That's mostly those gas portfolio effects we talked about, the high-cost gas, no curtailment gains. But again, they expect improvement driven by the long-term contracts kicking in.
Okay, greener commodities took the biggest hit. How about flexible generation?
Flexible generation came in with an adjusted EBDA of $61 million, which is, satisfactory, but definitely down from the record highs they saw previously.
Why the drop there?
Mainly lower commodity prices and tighter spreads compared to last year. Also, some plant decommissioning and transfers to reserve status played a role, although higher demand in the UK and Netherlands did help offset that a bit.
Got it. And the green generation part?
Yeah.
Hydro, wind, etc.
That contributed $246 million to adjusted EBDA, slightly below the prior year. The main reason was lower power prices in Sweden because of really high water flows affecting hydro output.
Too much water, ironically.
Yeah, exactly. But that was partly offset by better hydro results in Germany. And the full-year outlook for green generation is actually still positive. They expect higher results than last year, which, remember, was negatively impacted by some nuclear provision changes.
Okay. Any other notable financial points? Depreciation?
Depreciation and amortization was actually down $20 million year on year. That's mostly due to earlier impairments and some plant closures coming off the books.
And interest?
They had a positive result there. Economic interest and other financial results came in at $89 million positive, helped by interest effects on long-term hydro provisions.
What about taxes and cash flow? That must have been impacted by the government repayment.
Definitely. Income tax on the operating result was $48 million, an operating tax rate around 26.4%. But operating cash flow was heavily negative, minus $1.1 billion.
Minus $1.1 billion. Wow.
Yeah, largely driven by that big $2.6 billion repayment to the German government. That outflow was softened a bit by lower working capital needs because they were drawing down gas from storage, but still a huge hit to cash flow.
So that obviously impacted their overall cash position.
For sure. The economic net cash position dropped from $3.4 billion at the end of last year down to $2.6 billion at the end of Q1. That lines up with the negative operating cash flow, plus investments of $177 million and divestments bringing in $268 million.
Okay, comprehensive picture there. Lastly, let's touch on the Q&A session from the call. Any key clarifications or interesting tidbits?
Yeah, a few things. They clarify the relationship between their list of 13 brownfield sites and 13 gas plants in Germany related, but not a direct one-to-one mapping. Importantly, they stuck to their $8 billion capex plan. No change there. However, they did say the spending is now expected to stretch into the early 2030s.
A delay. Why?
Seems like longer timelines for getting flexible generation projects built, and also the hydrogen market developing maybe a bit slower than initially hoped.
Makes sense. What about that 2 gigawatt target for new German gas plant? Did they connect that to their market share goal?
They did. They said aiming for around 2 gigawatts fits with their ambition to keep roughly a 10% market share in German generation. No specific cost figures given yet, though.
And are they definitely going to build these, or is it conditional?
Very much conditional. They reiterated that any investment, any new plant has to be financially viable. So they're waiting to see the final design of Germany's capacity market auctions before committing capital.
Prudent. Anything else stand out? Sweden. Costs.
They confirmed their Swedish power plants remain core to the strategy, and they did acknowledge this inherent tension, right? Everyone wants lower energy costs, but we need massive investment in networks and new generation.
Yeah, that's the big conundrum.
But they sounded somewhat optimistic that the German government is focused on security of supply and is open to different technologies, which could help manage costs eventually. They also noted global trade policy could impact energy demand, which is another factor to watch.
All right, that brings us to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on all this. Your turn first.
Okay, here's one. Given Germany's push for new gas plants and Uniper's position, maybe look beyond Uniper itself. How about a long position in companies that specialize in making the gas turbines? Specifically, those with a strong track record in big German energy projects.
The suppliers.
Yeah.
Playing the infrastructure build-out.
Exactly. If the tendering process moves fast like Uniper hopes, these specialist manufacturers could see a surge in orders. But remember, this is absolutely not financial advice.
Definitely not. Okay, my turn. Thinking about Europe's continued reliance on gas, Uniper's long-term LNG deals, and, the ever-present geopolitical risks. What about a leveraged long position in European natural gas futures, but further out, say for the winter of 2026-2027?
Interesting. Why then?
Well, 2026 is when Uniper expects the crisis hangover effects to be gone from their midstream business. Maybe the market starts pricing in more normal supply risk again by then, especially if tensions flare up somewhere. Could be amplified. Again, purely speculative, not financial advice.
Intriguing plays, both of them. Okay, so that wraps up our deep dive into this latest earnings call. We've gone through the results, the strategy shifts, the financials, the Q&A.
Yeah, quite a lot to digest. So for you listening, what really stands out from this analysis, and is worth going back over the details and thinking about how these pieces fit into your own view of the company and the energy market.
And as you mull over Uniper confirming its outlook despite that weak start, alongside these big plans for new gas capacity. Here's a thought. Are we seeing a key European energy player truly stabilizing and setting course for the future?
Or are there still some hidden currents, some big uncertainties under the surface, given the energy transition and everything else going on?
Something to think about.
Indeed. Join us next time on TalkTickers for another deep dive behind the numbers.